Right now, there are approximately 1.4 million homeowners in the UK who have no idea what's about to hit them. They're living in their homes, paying their mortgages, getting on with life. But in 2026, something is going to happen that could push thousands of them into financial crisis. Their fixed-rate mortgage deals are ending, and when they remortgage, their monthly payments are going to jump by hundreds, sometimes over £1,000. This isn't speculation, this is already locked in. The trap has been set, and most people haven't even realised they're walking straight into it. According to UK Finance, around 1.6 million mortgage deals will expire in 2026. These are people who locked in ultra-low rates back in 2021 and 2022 when the Bank of England base rate was still at 0.1%. They fixed for 5 years at rates of 1.5%, sometimes lower. They thought they were being sensible. They locked in cheap borrowing for half a decade. But what they didn't account for was what would happen when those deals ended. Let's talk about how we got here, because this trap was years in the making. After the financial crisis of 2008, the Bank of England dropped interest rates to unprecedented lows. The base rate hit 0.5% in 2009 and stayed there for years. It was emergency monetary policy designed to prevent economic collapse. Cheap borrowing was meant to stimulate the economy, encourage spending, and prevent deflation. For homeowners, this was brilliant news. Mortgage rates fell to levels never seen before. By 2020, you could get a 5-year fixed-rate mortgage for under 1.5%. Some deals were below 1%. If you borrowed £250,000 at 1.2%, your monthly payment was around £900. That's affordable for a household earning £50,000 a year. It's manageable. It leaves room for everything else: savings, holidays, a car, raising children. Millions of people took advantage of these rates. First-time buyers stretched to get on the ladder. Existing homeowners remortgaged to lock in cheap deals. Buy-to-let landlords refinanced their portfolios. The property market boomed because borrowing was so cheap. House prices surged. Between 2020 and 2022, UK house prices rose by over 15% nationally. In some areas, it was 20 or 30%. But then everything changed. In late 2021, inflation started rising. At first, it was dismissed as temporary. Supply chain disruptions from the pandemic, energy prices ticking up. Nothing to worry about. But it didn't go away. By 2022, inflation was accelerating. Russia's invasion of Ukraine sent energy and food prices soaring. Inflation hit double digits. The cost of living crisis began. The Bank of England had no choice but to respond. In December 2021, they raised the base rate for the first time in over 3 years. It went from 0.1% to 0.25%. That sounds small, but it was a signal. Cheap money was ending. Over the next 2 years, the bank raised rates 14 times in a row. By August 2023, the base rate hit 5.25%. That's the highest level since 2008. For anyone coming off a fixed-rate deal during this period, the impact was brutal. People who had been paying 1% suddenly faced rates of 5 or 6% when they remortgaged. Monthly payments doubled or tripled. Households that were comfortable became stretched. Households that were stretched became desperate. But here's the thing. The worst of this hasn't happened yet. The people remortgaging in 2023 and 2024 were mostly on 2-year fixes. They locked in low rates in 2021 or early 2022. Yes, they got hit hard when their deals ended, but the numbers were manageable. We're talking about maybe 800,000 households spread over 2 years. 2026 is different. 2026 is when the 5-year fixes from 2021 mature. And there are far more of them. When rates were at rock bottom in 2021, mortgage brokers were practically begging people to lock in for as long as possible. 5-year fixes were barely more expensive than 2-year deals, sometimes even cheaper because lenders were competing so aggressively. The advice was universal: lock in now. Rates can't stay this low forever. Get certainty for 5 years. People listened. According to data from the Financial Conduct Authority, 5-year fixed-rate mortgages became the most popular product by far. At the peak, they accounted for nearly half of all new mortgage lending. That's an enormous concentration of deals all set to expire around the same time. So what happens when these deals mature? Let's walk through the numbers, because this is where the trap becomes clear. Imagine you bought a house in 2021 for £300,000. You put down a 10% deposit, so you borrowed £270,000. You locked in a 5-year fix at 1.3%. Your monthly payment was around £930. For a household earning £60,000 combined, that's comfortable. You're spending roughly 18% of your gross income on the mortgage. You can afford bills, food, transport, save a bit, and still have a decent quality of life. Now fast forward to 2026. Your 5-year fix ends. You need to remortgage. You still owe around £250,000 because you've paid down some capital, but not much over 5 years. You go to your lender to see what rates they're offering. And here's the problem. Even if the Bank of England has cut rates slightly by then, which is possible but not guaranteed, mortgage rates are not going back to where they were. The cheapest 5-year fixes available right now are around 4.5%. In a best-case scenario, they might fall to 4% by 2026. That's still 3 times higher than what you were paying. At 4% on £250,000, your monthly payment jumps to £1,320. That's an increase of nearly £400 per month, £4,800 more per year. And remember, this is the optimistic scenario. If rates stay where they are or go higher, your payment could hit £1,500 or more. Can your household absorb an extra £400 to £600 in monthly costs? For some people, yes. If you've had pay rises, if you've been promoted, if your financial situation has improved since 2021, you might manage. But for many, this is devastating. Let's be specific about who gets hurt worst by this. First-time buyers who stretched to get on the ladder in 2021 are in serious trouble. They borrowed the maximum amount they could afford based on those ultra-low rates. Lenders stress-tested them, but only up to a certain point. The stress tests assumed rates might rise to 3 or 4%, not 5 or 6. These buyers have no equity cushion. They put down small deposits. If they need to sell because they can't afford the new payments, they might be in negative equity if house prices have fallen in their area. People who bought near the peak of the market in 2022 are even more vulnerable. They paid inflated prices driven by cheap borrowing and pandemic demand for more space. If they're remortgaging in 2026 and house prices have stagnated or fallen, they could owe more than their home is worth. That makes remortgaging difficult. Some lenders won't refinance if you don't have enough equity. You get stuck on your lender's standard variable rate, which is even more expensive than a new fixed deal. Young families are particularly exposed. If you bought in 2021 and had children since then, your financial situation has probably gotten tighter, not looser. Childcare costs in the UK are among the highest in Europe. If one parent reduced their working hours or stopped working entirely, your household income has fallen while your costs have risen. Now add an extra £500 to your monthly mortgage payment. Something has to give. Self-employed borrowers face extra hurdles. If your income fluctuated during the pandemic or you've had variable earnings since then, lenders might not offer you the same loan amount when you remortgage. You could be forced to pay down a chunk of the mortgage just to meet lending criteria. But where do you find that cash? You don't have it sitting around. You've been using all your income to cover rising living costs. Now let's talk about what happens at scale when over 1 million households face this situation simultaneously. Mortgage arrears are going to rise. They're already trending up. UK finance data shows mortgage arrears increased by 18% between 2022 and 2024. That's with only a portion of borrowers having remortgaged so far. When the 2026 cohort hits, arrears will spike further. Repossessions will increase. Lenders don't want to repossess homes. It's expensive, time-consuming, and creates bad publicity. They'll try to work with borrowers, offer payment holidays, extend mortgage terms, switch to interest-only temporarily. But for some borrowers, none of that will be enough. If you genuinely can't afford the payments and you have no savings or family support to fall back on, repossession becomes inevitable. The property market will feel the pressure. If thousands of homes come onto the market because people can't afford their mortgages, supply increases. If supply increases while demand is weak because borrowing is expensive and wages haven't kept up, prices fall. That might sound good for buyers, but it's catastrophic for anyone trying to sell or remortgage. Falling prices mean falling equity, which means higher loan-to-value ratios, which means worse mortgage rates or no mortgage at all. Consumer spending will drop. If your mortgage payment goes up by £500 a month, that's £500 you're not spending elsewhere. Multiply that across 1 million households, and you're talking billions of pounds being sucked out of the economy. Retail suffers, hospitality suffers, discretionary spending disappears. Economic growth slows or reverses. That means job losses, which feeds back into more people struggling with mortgages. It's a vicious cycle, but here's what really needs exposing. The government and the Bank of England know this is coming, and they're doing almost nothing to prepare people for it. There's been no major public information campaign warning borrowers about what to expect when their fixes end. There's been no policy intervention to smooth the transition. The assumption seems to be that people will just figure it out, tighten their belts, and cope. But that's not reality for hundreds of thousands of households who are already stretched thin. The Bank of England's position is that they had no choice but to raise rates because inflation had to be controlled. That's fair. Runaway inflation is destructive, but the speed and scale of rate rises was the most aggressive in decades. They went from 0.1% to 5.25% in less than 2 years. That's a 50-fold increase. No economy, no housing market, and no household budget can absorb that kind of shock without serious pain. And here's the uncomfortable truth. The people making these decisions, the policymakers, the central bankers, the economists advising them, they're insulated from the consequences. They own their homes outright, or they're on high salaries that make mortgage increases manageable. They're not the ones lying awake at 3 a.m, wondering how to find an extra £600 a month. Let's talk about what mortgage lenders are doing, because their role in this trap is significant. When rates were at record lows, lenders were falling over themselves to write new business. They offered cashback deals, free valuations, low arrangement fees, anything to attract borrowers. The competition was fierce, profit margins were tight, but volumes were huge. Everyone was remortgaging or buying. Now that rates have risen, lenders are far more cautious. Lending criteria have tightened. Stress testing is more rigorous. Some lenders have pulled products entirely for certain customer types. If you're self-employed, if you have a modest income, if you're older and closer to retirement, you're finding it harder to get approved. And here's the thing, lenders make more money when rates are high. Yes, volumes are lower because fewer people can afford to borrow. But the margins are much better. A mortgage at 5% is far more profitable than one at 1%, even accounting for the higher risk of default. So lenders aren't incentivized to offer the cheapest deals possible. They're incentivized to maximize margins while managing risk. Some borrowers coming off fixed deals are finding they can't remortgage at all. Their income hasn't kept pace with house prices and higher rates. They don't meet the affordability tests. They're stuck on their existing lender's standard variable rate, which can be 7% or more. That's financial punishment for the crime of having borrowed when rates were low. There are also stories emerging of lenders pushing borrowers onto longer mortgage terms to make payments appear affordable. You borrowed over 25 years, but when you remortgage, they suggest extending to 30 or 35 years. Your monthly payment stays manageable, but you're paying interest for an extra 5 or 10 years. Over the life of the mortgage, that costs tens of thousands of pounds more. It's a trap disguised as help. Now let's talk about regional variations, because this trap doesn't affect everyone equally. In London and the South East, where house prices are highest, the pain is amplified. If you borrowed £500,000 in 2021 at 1.5%, you are paying around £2,000 a month. At 5%, that jumps to over £2,900. That's an extra £900 per month. Even high earners feel that. For middle-income households in expensive areas, it's unaffordable. In the North and Midlands, where houses cost less, the absolute pound amounts are smaller. If you borrowed £150,000, Your payment might go from £600 to £900. That's still a 50% increase and still painful, but it's not quite as catastrophic as an extra £1,000 in London. But here's the thing, wages in cheaper areas are also lower. A household in Newcastle earning £40,000 is proportionally as stretched by an extra £300 as a London household earning £80,000 paying an extra £600. The relative pain is similar even if the numbers look different. Scotland and Northern Ireland have slightly different mortgage markets and slightly different economic conditions, but the fundamentals are the same. Low rates in 2021, high rates now, mass remortgaging in 2026. The trap exists across the entire UK. Let's talk about what you can actually do if you're one of the people facing this situation. First, don't wait until your fixed deal expires to think about remortgaging. Most lenders let you lock in a new rate up to 6 months before your current deal ends. If rates are lower now than you think they'll be in 6 months, lock in early. You might save yourself a significant amount. Second, speak to a mortgage broker, not just your current lender. Your existing lender will offer you a product transfer, which is easy and doesn't require a new affordability check. But it's not always the best deal. Other lenders might offer lower rates or better terms. A good broker searches the whole market and finds the best option for your specific situation. Third, look at your budget honestly. If the new mortgage payment is going to be £400 or £500 higher, where is that money coming from? Can you cut spending elsewhere? Can you increase income? Can you rent out a room? These aren't fun conversations, but they're necessary. Don't assume you'll just manage. Work it out on paper. Fourth, consider extending your mortgage term. Yes, it costs more over the life of the loan, but it reduces the monthly payment. If the choice is between extending to 35 years or falling into arrears, extend. You can always overpay later if your financial situation improves. Fifth, talk to your lender if you're genuinely struggling. They have options. They can offer payment holidays, switch you temporarily to interest only, or restructure the loan. They don't want to repossess your home. It's expensive for them and damaging for you, but you need to engage with them early, not after you've already missed payments. Sixth, don't panic and make rash decisions. Selling your home in a falling market because you're scared of higher payments might not be the right move. You might be better off weathering a few difficult years and waiting for rates to fall again. Every situation is different, but don't act out of fear. Now let's expose what the government could do, but probably won't. They could introduce targeted support for households facing mortgage payment shocks. Other countries have done this. During the financial crisis, some governments offered temporary payment subsidies or guaranteed loans to help people through the worst period. The UK government has done nothing comparable this time. They could pressure the Bank of England to cut rates faster. The bank is independent, but the government sets its remit. If the Chancellor wanted to prioritise avoiding a mortgage crisis over hitting the exact inflation target, they could make that clear. They haven't. They could reform stamp duty to make it easier for people to downsize without massive tax bills. If you're struggling with mortgage payments on a big house, selling and buying something smaller makes sense. But stamp duty punishes you for moving. Reducing or eliminating it for downsizers would help. They could invest in social housing, so people who lose their homes have somewhere affordable to go. The social housing waiting list is over 1 million households long. If repossessions rise, where do those people go? Private rentals are even more expensive than mortgages. Without social housing, they end up homeless. But none of this is happening. The political focus is elsewhere. The government talks about building more houses, which is important long-term, but does nothing for people facing a payment shock in 2026. They talk about economic growth, but growth doesn't help if you're being repossessed this year. Let's talk about buy-to-let landlords, because they're caught in this trap too, and when they react, renters suffer. Landlords who bought or remortgaged in 2021 face the same rate increases as homeowners. But they've also lost mortgage interest tax relief, which used to make buy-to-let profitable even with modest rental yields. Now they're facing higher mortgage payments with less tax relief. Many are selling up. Landlord repossessions are rising even faster than homeowner repossessions. When landlords sell, Tenants get evicted. Section 21. No-fault evictions are still legal in England, though the government keeps promising to ban them. Tenants get 2 months' notice and then they're out. The property goes on the market, a new landlord buys it, or a first-time buyer does, and either way, the tenant has to find somewhere else. But rental supply is tight. Demand is high because fewer people can afford to buy. When supply is tight and demand is high, rents go up. They've already increased by over 30% in the last 5 years. If more landlords exit the market in 2026 because they can't afford their mortgages, rents will spike even higher. So renters face evictions and rent increases at the same time homeowners face payment shocks. Everyone loses except the people who already own property outright. Here's what the Bank of England will tell you. They'll say interest rates are still historically normal. 5% is roughly the average over the last 50 years. The problem wasn't that rates went up. The problem was that they were artificially low for too long, and people got used to it. Now we're returning to normal, and that's painful but necessary. There's some truth to that. Rates couldn't stay at 0.1% forever. Ultra-low rates create bubbles, encourage excessive borrowing, and distort investment. Returning to more normal levels is healthy long-term, but the transition matters. Going from near 0 to 5% in 18 months is a shock. A gradual increase over 5 or 6 years would have been manageable. People could have adjusted, wages could have caught up. The housing market could have cooled slowly instead of slamming on the brakes. The bank will also say they warned people this could happen. They did. Sort of. They said rates might rise. They said borrowers should stress test their budgets. But warnings are abstract. When you're getting approved for a mortgage at 1% and you're being told you can afford it, you believe it. You trust the system. You don't seriously imagine your payment might double in 5 years. And let's be honest, the stress tests were inadequate. Lenders tested whether you could afford payments if rates rose to 3 or 4%, not 6 or 7. The tests assumed gradual increases, not rapid spikes. They weren't designed for what actually happened. Now let's talk about the psychological impact, because this isn't just about numbers. Your home is supposed to be your safe place. It's where you raise your family, where you build your life. The idea that you might lose it because of forces completely outside your control, because central bankers in London made decisions about interest rates, because inflation happened halfway around the world and pushed up energy costs, that's deeply unsettling. The stress of financial insecurity affects mental health. People lose sleep. Relationships suffer. Health deteriorates. There's shame and embarrassment around struggling with money, even though it's not your fault. You feel like you're failing when actually the system has failed you. And there's anger. Justified anger. You did everything right. You saved for a deposit. You bought within your means based on the information available. You locked in a fixed rate to protect yourself, and still you're facing a crisis. The rules changed after you'd already committed. That's not fair, and people know it. Here's the really dark part. Some financial institutions and investors are positioning themselves to profit from this crisis. There are firms waiting to buy distressed properties from people who can't afford their mortgages. They'll offer below-market prices to desperate sellers who need to get out fast. They'll accumulate portfolios of undervalued assets and then sit on them until the market recovers. There are debt collection agencies preparing for an increase in mortgage arrears. They buy bad debt from lenders at a discount and then aggressively pursue borrowers for payment. It's profitable work when defaults are rising. There are corporate landlords ready to expand. When individual buy-to-let landlords sell up because they can't afford their mortgages, who buys? Often it's large property companies with access to cheap institutional finance. They're happy to wait out a downturn because they're playing a long game. More rental properties under corporate ownership means less competition, higher rents, and worse conditions for tenants. This is how wealth transfers happen during crises. Ordinary people lose assets they've spent years building equity in. Well-capitalized institutions buy those assets at distressed prices. Wealth concentrates further. So what's the timeline for all this? We're in late 2025 now. The first wave of 5-year fixes from 2021 are starting to mature. But the peak hits in mid to late 2026. That's when the bulk of these mortgages need to be refinanced. If the Bank of England cuts rates between now and then, which is possible if inflation stays under control, the impact will be slightly less severe. But even with cuts, rates aren't going back below 2% anytime soon. The payment shock is still coming. If there's a recession, which is also possible given weak economic growth and high household debt, everything gets worse. Unemployment rises, which means more people defaulting on mortgages. House prices fall, which creates negative equity. Lenders tighten criteria even further, making remortgaging harder. The optimistic scenario is that the economy holds up, wages grow, inflation stays low, the bank cuts rates modestly, and most people manage to absorb higher payments with some difficulty, but without disaster. That's possible. It's not guaranteed. The pessimistic scenario is a housing market crash triggered by forced sales, a spike in repossessions, falling prices creating negative equity traps, a credit crunch as lenders panic, and a broader economic recession. That's also possible. Most likely, we get something in between. Significant pain for a substantial minority of homeowners, moderate pressure on the overall market, localized crashes in areas where prices were most inflated, gradual adjustment over several years rather than sudden collapse. But even the moderate scenario involves real suffering for hundreds of thousands of people. These aren't statistics. They're families losing homes, their people's financial security being destroyed, their life plans being shattered. You should be asking yourself where you fit in all this. If you're remortgaging in 2026, are you prepared? Have you run the numbers? Do you know what your payment will be? Have you got a plan? If you're not directly affected, do you know someone who is? A family member, a friend, a colleague? Because the chances are high that someone you know is walking into this trap. And politically, are you paying attention to who's offering solutions and who's just offering platitudes? Because this is a policy failure that's been years in the making, and it's not being taken seriously enough. Let me know in the comments what your situation is. Are you facing remortgaging in 2026? Have you already been through this and felt the payment shock? Are you worried about what's coming? The more people share their experiences, the harder it becomes for this to be ignored. And if you found this useful, subscribe to the channel. There's going to be more on this topic as we get closer to 2026. You need to stay informed because the institutions that created this problem aren't going to warn you about what's coming.